Hello everybody, my name is Ken W. Chow and this is my superstructure trading webinar. I have an engineering background, so when I was looking for trades, I wanted something that would make sense, something that would make logical sense. And after going through all of the indicator-based systems and getting burned, I set out to look for what really works in trading all markets. And I finally concluded that it was chart reading and knowing how to see price action, setting up for a good trade. And in this webinar, I will share with you some of my most powerful tools which can help you improve your trading in terms of reading trend, direction, and trend strength. So let's get started and talk about superstructure trading. Now, what is superstructure trading? What is the essence of superstructure trading? Well, the goal of superstructure trading is to find the predictable leg of the market. And the way to do that is we look for trend direction. Is it going higher or is it going lower? And then we look for trend strength. Now, evaluating trend strength is very important. By knowing how strong the trend is, you can either trade with the trend or against the trend. Let me go and talk about the discussion of today. Now, we will talk about identifying a measured move. We'll talk about what a measured move is. We're going to talk about the two measured move strategies that are derived from the measured move. Strategy number 1 and strategy number 2. Now, for those of you who have my chapters 1 and 2, these two strategies are at the back of chapter 2. Okay. Now, for those of you who do not have that, I'm going to talk about later how you can get this for free, chapters 1 and 2, with these two measure move strategies. Now, another thing that we use in superstructure trading is Fibonacci ratios, but not any Fibonacci ratio. We'll talk about what it means to have extreme Fibonacci extension ratios. Okay. And then we'll talk about skewing. Skewing is one of the most powerful tools that can be used for trading. And you can go home right after this webinar and check for yourselves in terms of where skewing can show up around 80% of all turning points in all time interval charts. Okay. Now again, skewing, like all the other tools, is best used in combination instead of using by itself. But I've seen students who use this by itself and they would make very good trades. Finally, questions and answers towards the end. Let's talk about labeling a measured move. Okay, what is a measured move and how do we label the measured move? Well, this page says we start with B, tentative C, and then we will search for a pivot A to conform to the definition of trend. So B first, C, and then A. What does that mean? Well, let's take a look at what a measured move is. I'm going to draw two measured moves. Now, this is a bullish measured move and this is a bearish measured move. As you can see, all markets move in this direction. They don't just go up straight bar to bar. They go and they pull back and they zigzag up and down, down and up. Now, this is the integral part of what a measured move is. Okay, this pattern to the left is an up move. This is a down move. You might say, well, sure, that's so easy. But how do we know this is an actual up move and where is it confirmed? Well, what we do is, let me not do this first. We will look for a pivot high here. And if it breaks above the pivot high right here, we will call that point B, possibly a point B. Now, if we come off of a pivot low that is higher than the previous pivot low, then we can call this point C and then finally point A. So therefore, the confirmation is right above here at point B. Only when it goes above point B do we have actual confirmation. Now, why is that important? Because the very definition of an uptrend is higher lows, higher highs. Okay, higher lows means pivot low of C is higher than A, and once we move higher than B, right about here, we are on our way higher to point D, uptrend. By definition, it is higher lows and higher highs. Well, how about a downtrend? Well, once we move below this low over here, this may be a point B if this pivot low is lower. I'm sorry, this pivot high is lower than this pivot high. Lower high and the lower low, right below point B. Now, does that mean that we automatically do a breakout below point B? Well, we're talking about trend direction right now. We haven't talked about trend strength yet. If we're going to go short below point B or go long above point B, what you're really saying is breakout trades. Okay? If you break above point B, you have a higher low, higher high. Hey, definition, that's an uptrend. Okay? We should go long, right? Because the saying says, go with the trend is your friend. Well, let me revise that. I'm going to say go with a strong trend, because a strong trend is your friend. It's a better friend, whether it be up or down. Okay? Just because you have trend direction, in this case up, and in this case down, you don't have any firm confirmation that you should go with the trend yet. All you know is that directionally it's going higher or lower. So you want to know trend strength as well as trend direction. Okay, by labeling A, B, C, D this way, starting with B, and then C, and then A, and then D, we know that we have trend direction. And the rule of thumb says that the CD leg should equal to AB. The CD leg should equal to AB. Now, in the real world, does it always equal to AB? No, not really. It can be a lot higher, point D, or it can be a lot shorter. The CD leg can be a lot shorter than an AB move. Now, why would that be? Again, that goes back to the strength of the trend. In a somewhat balanced situation, CD will equal to AB. But in a real life situation, the CD leg could be stronger, could be weaker due to trend strength. So how do we define trend strength? How do we know what is a strong trend and what is a weak trend? Well, let me draw two diagrams. Okay. This diagram is to the left, and this diagram is to the right. Now, in both situations, you have higher lows, higher highs. We have higher lows. C is higher than A. The C is also a pivot low that's higher than the previous pivot low. And of course, we broke above here, so this is point B, as is this point B. Well, in both situations, we have an uptrend. But clearly, one is a stronger uptrend than the other. Why? How can you tell? Well, the answer is you can tell by seeing what the retracement of the BC leg looks like against the AB move. In other words, the pullback against the thrust is going to tell you how strong this up move is. Now, simple geometry says that the CD leg in this diagram to the left, point D should be just about, maybe about here. Okay. Diagram to the right says point D should be way up there. Why is that? Because of the nature of the pullback. The pullback isn't very deep in this diagram to the left. Therefore, it just couldn't wait to go up fast enough. I mean, that's called an uptrend, a strong uptrend. So the depth of the retracement will drive the strength of the move. The shallower the retracement, which is the lesser the pullback, the stronger the uptrend. The more you pull back and the deeper the retracement, the weaker the uptrend. Now, what do I mean by deep and shallow? I use the 50% mark as a rule of thumb. Now, of course, a lot of times it'll be very clear that it will be a lot less than 50%, or a lot less than, a lot more than 50% deep. So the depth of the retracement will tell you how strong the trend is. The shallower the pullback, the stronger the trend. Same thing goes for a downtrend, obviously. Okay, when you have a downtrend, this downtrend is not quite as strong as this downtrend because of the nature of the retracement. Okay, this one doesn't want to go down a whole lot, the diagram to the left, whereas the diagram to the right is showing you that it couldn't wait to go down quick enough. Okay, So knowing how deep point C is will tell you how strong the trend is. And from this knowledge, we can derive two measure move strategies. Okay. Now, measure move strategy number one starts out when you have a shallow retracement. So before that, we have a lower high, lower low. Okay, down, 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 and down. And all of a sudden, we have a higher low, higher high situation. Okay, right here, we are going up by definition because point C is a higher low than point A, and we moved above point B. Okay, how deep is the retracement at point C? Measure move strategy number one says if point C is a shallow retracement, dropping less than 50% of the AB thrust, we have a strong uptrend in place. And when this thing starts pulling back here, without the CD leg stretching out to where it equals to AB, there's a place to buy on pullback. And once this thing makes a move up from down to up, then you have an uptrend continuing. Okay, this is where you can buy it near the pivot lows here. There are several techniques to buy it here. I'm not going to get into all of them, but once you buy on a pullback and you put a protective sell stop one tick below point C, we will insist on this market giving us higher lows, higher highs. And what that means is each pivot low should be higher than the previous pivot low, and you can ride this move all the way up as you trail your stop. This tells you that the trend is strong based on point C over here, the first one out the gate, if you will. Okay, so you buy on pullback when you see a strong trend starting in a new direction. That's measure move strategy number one. And let me give you a quick example of something like that. We saw that in crude oil on the daily chart not so long ago. Okay, here we have a retracement of less than 50% here. Once it pulls back somewhere around here, buying over here would give you a move further up. Okay, so that's an example recently of September crude oil. Now let's talk about another measure move strategy, number two. The measure move strategy number two seems to be more common. Okay, and this is a chart of Apple. This goes back a year, and this chart shows how you start off with a deep retracement. Now, when you start with a deep retracement, which is right here in blue, you're talking about a move that isn't going to be a very strong move. But when you follow that with another pattern, in this case, the green pattern, showing a much shallower retracement, then right as we break above there, we can see that we have suddenly started to accelerate to the upside. Okay, 110 bucks is where this thing started to move up, and Apple went as high as like 280 recently. This was April of last year. Right? So in over a year's period of time, this thing started to move up a lot. And we can go back to a current Apple chart and see, I'll go to the weekly chart, okay, and see how that 09 situation over here has brought it all the way up. Okay, that's what we looked at earlier, right there on the daily chart. Okay, so there it is. So you start off deep and you go much shallower, going higher. And a lot of times that happens because you have this price action would come back to do a retest of the previous low. Okay, so you start off deep and you go shallower. In measure move strategy number two. In measure move strategy number one, you start off shallow and everything else is going to be teeing off of that, and therefore price will be going higher or strong or down, if in fact if it's a downtrend. Let's talk about another tool that we use, which is the Fibonacci extension, extreme extension. Here we have an A, again, this is the Apple weekly chart, B, C, down to point D. Now, that pattern there, now excuse me while I put this thing up for a second here. This is my little whiteboard. Okay, so here we have an A, B, C, D pattern here. As we extend down to about the 261% of the AB move, This is one of the extension extremes. This is not the only one. There's another one, which is a 361%. But this one is the first one that we need to address, meaning will there be a bounce there? Price action would chop around, and in that chopping around, this is telling us that it may or may not go down any further. Now, once you see something like this showing up, which we talked about just earlier, then we indeed have a higher low, higher high situation. That means we're going higher. However, we're not out of the woods yet because this is a very deep retracement. We talked about that, right? And then when the super shallow shows up right there, as we saw on the daily chart, then that thing has a way to follow through. So that's how you pick point B on the extension extreme. Now, as a side note, we want to make sure point C is a deep retracement, okay? Coming off of a deep retracement, it's better to buy it than if it's a shallow retracement. But this is the BC extension. And the extension is always against BC. And I'm going to give you some more examples here. Here is an uptrend of S&P a few months back. And this one also has a deep retracing point C here, pulling it down to the 261. This thing eventually went higher. Okay, you can find this on all charts and in all time intervals if you know what to look out for. And you can do stocks as well. Here's research in motion, RIM, and here we have a move going up here. We have again a deep retracement point C here. It worked its way up to the 261%, again of the BC leg. That's why you can see this faint line going straight above point C. Here is where price action ended, and there was some reporting of earnings, and then what happened was follow through on that. Now, on the way down, you also have another BC extension, but in this time, you're off of a shallow retracement at point C, going down. Point C isn't 50% of the pullback. It's less than that. But still, this 261% of the BC leg, you can look for an extension there. And using other tools, we can confirm a low here for a bounce. This bounce will not be a huge bounce, thanks to point C being not very deep. So we'll talk about all these rules in terms of how big of a move you can expect based on point C. Again, point C is very important. And the BC leg is what we're talking about here when we do extensions. Here we have double 261s extending in this daily chart of silver. Now, for those of you who are familiar with Fibonacci ratios, we like to use them as a cluster, to confluence, if you will. And the reason why is that they reinforce each other. Okay, so here's one pattern, which is the 261% of this pattern extending down here. And there's another one following it, and you can take the average of the two, and they'll reinforce each other for a move. Actually went a little higher to the 20s from there. This is silver. Okay, so you have double 261s helping each other out. That's another very powerful way. In fact, we do that all the time, using many things to help each other out. Here's crude oil earlier this year, and here's what happened. This is a deep retracement. Okay, this guy's 261 is right here mathematically. But how did we get down here? If it got down here very quickly, then this would be a strong down trending move where you don't want to buy it. But it didn't do that. It has this pattern here, deep retracing, deep retracing. This is telling you that we probably have a lot of situations where you can think about a buy here for a pop. Okay, so here's another example of how the 261%, along with the nature of how weak it came down, gives you a chance to buy this low here. But on its way up, it's a strong uptrend. And when it's a strong uptrend, this thing hit the 361. And we'll talk about the 361 in a second, how that can give you the reversal up here. Okay, the 361 is the next level above a 261. And there are things that we look out for that would tell us that it may not turn at the 261, therefore wait for the 361. We had a situation like that just about a week and a half ago in October Sugar, and you can watch that webinar in its entirety as to how that was predicted 2 days before it topped out. It was on a Thursday, July 29th, that we talked about July Sugar at the 361. So again, if you contact Pacific Trading Academy, they'll give you the access code to watch that 1-hour webinar in its entirety. So we have a lot of tools that we use, and the mathematical tools that I like being an engineer is this 261% or 361% single-sided extension. Now here we have everything laid out to help you calculate that longhand. Now I use Q charts, which is something that's simply a click and drag situation to give us a number in which to buy or sell. But if you want to do a longhand just for your own edification, this is how those extensions are calculated. Now let's take a look at some other, I'll give you one more here, and there's that 261 here going higher. Now notice how the 261 in this situation gave you a move here, but on its way down there's another little hiccup right here. Okay, these hiccups are telling you that it's a deep retracement following by another deep retracement. Let me draw this one in green. Okay, this is not the measure move strategy number 2, because it's not deep and then getting shallower. It's deep and remaining deep, buying it over here versus doing a breakout down here is a better play. Okay, because you're going, in this case, against a weak downtrend. This is a downtrend, lower highs, lower lows, but it is a weak and weakening downtrend. So these are powerful tools that you can use. Now let's talk about another powerful tool. Okay, this is the concept of what I call skewing. Now the skewing is always the skewing of point C. I have some students who, when they're day trading, they can simply pick off these skewing things and they can go and pick highs and lows. Now, point C, we talked about earlier as a tool that can be shown, that can show us how strong the trend is by its retracement. Okay, but here we have 3 retracements of point C. Okay, now the way I've drawn it, all 3 retracements are the same in terms of the depth. The BC leg is about 50% of the AB up move. But wait a minute, this is clearly not the same. Each one of these things is telling you a different story, especially the so-called right skew versus the left skew. There's a difference here, and this type of skewing can tell you how strong the trend is. This is a line chart, okay, but the line chart is here to show what bar chart patterns are alike. So let's talk about this and see what this means. When is point C skewed to the left? Point C is skewed to the left when the drop here from this price high pivot high here down to this pivot low, and the number of bars or the amount of time that it required to drop here is a lot less than how many bars it took to recover and go right back above point B. So the actual bar that breaks above point B is where you want to count from point C. Point C is a pivot low that is bar 0, and if you count here, say 1, 2, 3, 4, 5, and 6, the 6th bar actually went above B. Now in this example, maybe only 2 bars would bring you down to C. Here, in 2 bars, you have traveled this amount of distance. Going back up the opposite way, it may take 6 bars to go up, get back to what took 2 bars to accomplish. So we're just measuring the same distance in both directions. And we want to see which one took faster, which one required less or more time. Now, if you draw a pivot right above point C, you can see a pivot, a vertical bar that is. You can see whether this vertical bar is closer to the pivot high that is B, or the actual bar that broke above point B. Is it closer to B or this bar? Well, if it's closer to B, then this is considered skewed to the left. Okay? Think about this skewing to the left situation. Is this move going up from C a strong move up or a weak move up? If you took faster to drop and then slower to recover. Think about that. Now think about skew to the right. When something is skewed to the right, the drop from B to C may consist of a lot of bars, a lot of short overlapping bars. And then all of a sudden from point C, you have one or two huge bars, and then now you're above B already. Okay? And once you have that action, you know that this move up is a strong move because the opposite pullback move is taking a lot longer than the move going back with the trend. This is what happens when you have a right skew. Now the left skew is a weak move, and then neutral is neutral. Okay. Now let's talk about the reverse situation. Same exact thing. You can have a neutral skew going down. You have a right skew going, a left skew going down, or you can have a skew to the right situation, and that could be the same type of thing. Whether it be upside down or right side up, when price action is skewed in a certain way, you can tell whether the trend is strong or not. This is aside from how shallow, how deep point C is. Okay. Now the skewing, we'll talk about skewing in terms of a ratio. In other words, if this took, let's say, 6 bars to get up here, okay, 6 bars, and only 3 bars down, that's a 2-to-1 ratio. If it's 6 up and then only 2 down, that's a 3-to-1 ratio. The more bigger the ratio, whether it be skew left or skew right, the more significant. The more significant it has as far as an impact on trend strength. So to summarize, when point C is skewed to the right, the trend is considered strong. When point C is skewed to the left, the trend is considered weak. Now that is in all markets, in all time frames, 60-minute chart, 5-minute chart, weekly chart, in bullish and bearish scenarios, upside down, right side up. Okay. Let's take a look at some examples. Here's a skewing to the left example, and all it is a move going up to B, and we're going to count the move from B down to C in terms of the number of bars. By the way, if you have 3 bars exactly at the same high, we use the very first one, likewise at point C. So here's bar 0, and from bar 0 we go 1, 2, 3, and 4. 4 bars down to C, and then from point C, 1, 2, 3, 4, 5, 6, 7. 7 bars to go back up above C. This is almost a 2-to-1 risk, 2-to-1 skew to the left situation, and this is the 1-minute chart on the Russell. The second pattern following this one also shows skewing to the left situation here. 1 and 2 down here. 1, 2, 3, 4, you're up here. So here we have a 2-to-1 skew to the left again. We call this back-to-back left skewing. Notice how this CD leg, which was supposed to equal to AB, now this thing got shortchanged, if you will. The CD leg, which was supposed to go all the way out to the CD equals AB area, has failed to do that due to excessive left skewing, as we say. All right. So too many patterns to skew to the left, you're simply not going to have a lot of energy to follow through. And here's an example. Recently, a student of mine pointed this out to me because he was looking at coffee, and this thing has a downward move, 30-minute chart, and this first one is skewed, what, to the left or to the right? This is to the right, okay? Because if you count the number of bars, let's say, as you see how this is done. 1, 2, 3, 4, 5, 6, 7 bars up here to the pivot high, which of course is point C, and then 1, 2, 3, 4, 5 down. Okay, so 7 up and 5 down. Now this is skewed to the right slightly, so this is going down relatively strong, not real strong. This is skewed to the right, but watch this. It's skewed to the left all of a sudden. You see that? And again, and again. This is like a lot of left-handed skewing. This is simply coming down gently. Now once this happens, and then you start to go higher lows, higher highs, then this is then suddenly an uptrend. But you can pick those lows here using Fibonacci extensions, by the way. As you see a bunch of left skewing coming into an extension, that would be a very good place to buy this market. Now once you buy this market, you can see how this thing has moved up. But let me show you a little bit of an update of this pattern here, and you can see how this actually went a lot higher, okay, after a bunch of left skewing into the lows here. So if you buy it here or a few shots at it, you're going to have a lot more ways to go over about a week's period off of a 30-minute chart of this persistently skewed to the left situation. So again, there's a slow downtrend. It's a very good situation to buy when you have that type of situation. Now 10-minute chart intraday, you can see how this actually on the E-mini S&P, you have a deep retracement here, point C. But notice how point C is skewed. 1 bar and 2 bars down to C. 1, 2, 3, 4, 5, 6, 7, 8, 9. And somehow it made its way up to here. Another left skew. This is where you want to short. And once you short there, it's a quick, fast drop, and you can get within some good, accuracy there. This is how you combine things to have superstructure trading, Fibonacci ratios, skewing, and so forth. Here's something that's skewed to the right. Okay. From here, we have a 1, 2, 3 bars down, and then 2 bars up. Notice how the CD leg is bigger than AB. In other words, the CD leg, AB equals CD should be around here. This thing went a little higher thanks to right-handed skewing. But if you watch carefully, there was a pattern that preceded this that was also right-handed skewing right here in green, okay? And if you look carefully here in blue, this one was also skewed to the right. So here you have persistent right-handed skewing. The blue one, 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 down, 1, 2, 3, 4. You're up here already, okay? And then the next one, this, in other words, you have several of these in a row, it reinforces each other. 1, 2, 3, 4. 1, 2, 3. Okay? So it kind of, it's like leaning to the upside, upside, upside. By the way, how far up should this thing go before it peters out? I'll give you a hint. 261 extension. So you can use how, you can use both tools or all the tools together, the extensions and the retracements and the skewing. Let's take a look at this that we talked about a year ago, which is the weekly chart of the Dow Jones. We talked about 1-minute chart and daily charts and weekly charts. Here's a weekly chart, and you can see how this one actually came off of the lows there back in March 6th of March 9th of 09. That's where the stock market bottomed out. Now it went all the way up here. It pulled back less than 50%, which is a strong trending situation. Once we broke above here off of a shallow retracement, less than 50%, but there's also skewing involved, meaning it took 4 bars or 4 weeks to drop from here to here, but only 2 to get right back above there. This means this is going up very strongly. So once you moved above there, right about here, you can think long. You can buy all types of equities. This was back a year ago, July. This is not this year. Around 9,000. This thing started to move up and up and up. Now let's take a look at current price action and see where the weekly chart of the Dow Jones is located. And here's what we did earlier. We just did this as a shallow retracement, super shallow actually, to the right. This thing made its way up from 9,000 all the way to 11,000. Now, to make a long story short, how does this thing peter out? Well, this is a right skew. Look at this. It's a left skew. So right above here, is a good place to be careful because you're coming off of a left skew. How many bars from here to here? How many bars to go right back up above there? It's skewed to the left. Well, let me open it up so you can see it. This is what we do on a 1 minute chart, 5 minute chart, weekly chart. It does not matter. It's the same concept. This high is higher than that high. Okay, so from here, 1 and 2, you're down here already. Now to go back above this high, we're going to see this bar right there. And how many bars later did we get up there? Now there's 2 bars down. This is bar 0, 1, 2, 3, 4, 5, 6. So when we have a 2 to 6, this is like a 1 to 3 ratio. Okay, what brought it up was 2 to 1, and what killed it was 1 to 3. Now above here somewhere, it's fair game. Fair game to go short. And that's what happened on that. Remember that flash crash in early May? Okay, that was a result of a lot to do with this left skewing. Right above here is very unstable. Wasn't able to go up too much further due to left-handed skewing. So the skewing to the left is a good tool for us to use in terms of looking for an end of a move. And here's some other situations here about skewing. This is recent. I have a student who made $4,700 going long on the December week. This is current. This is this year. And you can see how skew to the right. 1, 2, 3, 4, 5, 6, 7 bars. You're down here. Boom. 1 bar. You're above here already. This is called skew to the right. Now it's a deep retracement. Okay. Now what followed that was a shallow retracement, and it's still skewed to the right. Boom. Over here. Right. And again and again. You see, again and again. Right. This is telling you that this is still moving very strongly. Now it's going to go up to the super duper extreme, and let me give you another updated view of week. This thing went all the way up. Now also snapped right back down due to some super duper extreme, but this thing had a chance to continue going up as we have all these indicators, if you will, or signs or chart patterns that are telling us that the trend is strong. This is the recent chart pattern of the Dow Jones, the S&P, I'm sorry. This was just earlier in July. This was done just a few days ago. And this was a neutral skew, okay, 3 down, 3 up. Then recently we have this 3 bar down and 1 bar up on this daily chart of the S&P. Now, what happened yesterday, Friday and today? Well, Friday was an unemployment report, knocked it down, but it came right back up. And today, let's take a look at the S&P today. We moved up. We moved up a little bit, okay, because this right-handed skewing that was a 3 bar down and 1 bar up we broke above here, and from here we're really trying to move up a little bit here. Now today we kind of was a narrow ranging day because tomorrow's the FOMC report, but the overall trend tells us that we want to fight our way a little higher due to neutral skewing converted into right-handed skewing. So, so that's what we want to take a look at. Okay, neutral 3 to 3 skew, and then 3 to 1 to the right. That's telling us that, hey, we may be coming into something strong. So that's the kind of thing that we look for. Let me give you one example here. Last example here. Here we have the bonds. Bonds showed going down, a deep retracement here, and is also skewed to the left. What is this downtrend telling you? Strong downtrend or a weak downtrend? It's a weak downtrend. But wait, the next one following it is even deeper and skewed to the left still. Again, once we get below here, it's buying opportunity, okay? Because it can't go too much further down. And once it snaps right back above here, this should be going higher. So again, buying on a weak downtrend makes sense. Let's see what the updated chart looks like of bonds. This was taken some time ago. Here's bonds, and there's that thing, and then went pretty strong to the upside. Now I say pretty strong because of what? Shallow retracement right here. Okay, so right there is shallow retracement, therefore it can go a little higher. So buying it over here off of deep and deeper retracement, persistently skewed to the left, and skewed to the left skewing of these point C's, makes sense for you to buy it here. And you wait for that pattern to complete, because according to Elliott is 1, 2, 3, 4, 5 wave pattern. But according to superstructure, it's simply 2 measure moves back to back. And you can tell whether the second pattern, the second measure move, is gaining momentum or losing momentum to the downside for you to determine whether buying it makes sense or not. And in this case, it does make sense, okay, because you analyze 2 measure moves, and therefore you can have them tell you a story of how strong the move is. Okay, so in summary, what we're saying is superstructure trading allows you to read the strength of the trend, where you can pick highs and pick lows with confidence and in advance. Okay, you can smell a high coming or a low coming, so you can get your orders ready. If you want to do breakout trade, you want to avoid most false breakouts. And what's the best type of breakouts? Well, remember that term, a trend is your friend, a strong trend is a better friend? Well, in doing breakouts, you want to make sure that the trend is very strong to follow through nicely. So what do you want? You want super shallow retracements at point C and skewing to the right of point C for it to break through and follow through. That will eliminate a lot of the bad false breakouts. And this also allows you to properly manage a trade. If you can read the strength of the trend and see how strong the trend is, to see whether it's gaining strength or remaining strong or losing strength, by writing out a few measured moves, you can actually manage it properly. Okay, we'll go into that in detail in the course. And speaking of the course, what I've just put together is a course that is 6 chapters long on 5 DVDs. It's 4.5 hours. Okay, this home study course will talk about the complete measure move concept, skewing, and time range. Now, we did not have a chance to talk about time range here. It's a very, very important tool in superstructure trading. It is the third element behind retracements and skewing. If you have a conflict between skewing and retracements, the time range will shine a light as to which way to go. We talked about powerful extreme Fibonacci ratios, 261s and 361s, and there's another ratio that's very, very powerful that can give you a turnaround. Okay, and I'm telling you, it's not. Give you a hint. It's not an extension, but it's also very, very powerful. Double tops and bottoms. What are they? How do you interpret them using superstructure trading? Okay, we talked about that. Gaps. How do you handle gaps if you're a day trader? How about trend lines? What do they mean? These tools are covered in its entirety because the actual DVDs are 4.5 hours long. Okay, it's not just to read or watch casually, but you have a lot of good information there. But there's more. With this course, you have 24 free webinar sessions. In fact, we gave away 24 webinar sessions in the past. Now we're giving 6 months worth of webinars. These webinars are held by me every Tuesday, Wednesday, and Thursday, sometimes 2 sessions per day. And we go over different types of webinars. One is a beginner webinar, one is considered a swing/position trading webinar, and then there's a day trading webinar. Day trading webinar covers the S&P, E-mini S&P day trading. These webinars are great because they actually give you a way to see what the setups, how we tear apart the setups, and a lot of times there will be a situation like on the 29th of July where we saw a move showing up in sugar and also a long in the S&P, and you can see how next few days price action would play itself out as per the predicted high or low. So I give away a price action where a high or low may come, and these webinars are great for you to attend and watch and attend. But if you cannot attend, these webinars are also archived and recorded. You also get free charts if I see a good chart pattern showing up. But the webinars are what really allows you to watch and learn and follow the patterns, because it's a video format and not just a chart format. Now, to learn more about this entire home study course and as a promotion for coming to this free webinar, I was told by Pacific Trading Academy that for those of you who don't have chapters 1 and 2 already, we're giving chapters 1 and 2 for free, giving it to you for free just for attending this if you want to ask for it. Now, again, contact Pacific Trading Academy. They have chapters 1 and 2, and they will give you access and ship them to you. Like I said, chapter 2, behind chapter 2 is that measure move strategy number 1 and 2 that is so powerful. I have some students who actually made 8 or 10 grand trading just off of those 2 strategies before they decided to buy the course. But for those of you who want to get started immediately, this is a fantastic way to see how powerful these chart patterns are. So contact Pacific Trading Academy. They have chapters 1 and 2 for you for free. If you want to watch this entire webinar over again, also contact Pacific Trading Academy to get the access code. If you want to watch these, one of these slides that you just saw, contact me directly at ken@superstructuredtrading.com, and I'll be happy to send and attach these slides over to you. Okay. All right. Now we're going to answer some questions that anybody may have, and this allows you to basically learn or find out more about this. And okay, anybody have any questions here so far? I don't see. We have Eric says shallow pullback. I'm not sure what that means, Eric. Okay. Can you expand on that, Eric? Okay. All right. So that's kind of like what we're talking about here. I'm not sure what Eric means by shallow pullback, but I think I answered a lot of the questions, as there are no questions that I've seen typed in. Oh, okay. I see some questions here. Comment on your question about trend strength. Oh, okay. Yeah, that's true. Trend strength means how is point C behaving, if you will. The behavior of point C tells us how strong the trend is. If point C is a very deep retracement and skewed to the left, then you need to be careful, because now it may be a weak trend. If point C is skewed to the right and shallow, that means the trend could be very strong. Okay, and then you use this in conjunction with other patterns as well. The best way to do that is when you combine price action with some resistance or support, which is given by Fibonacci extensions. Okay. All right. Any other question that we may have? All right. Well, I want to thank everybody for attending. And if you have any comments or questions, let me know. Again, if you want this entire webinar to go over again, the video portion, contact Pacific Trading Academy tomorrow morning, and they will give you the access code. If you want the slides, contact me. Okay, thank you everybody for attending.